This last year has been particularly tricky for car buyers, and chances are if you're somebody that has purchased either a new or used car over the last 2 years, you probably overpaid for that car. And in some cases, you may actually be underwater on that car, which means that you owe more on the vehicle's loan than that vehicle is actually worth. And if you're somebody who's in this situation, chances are you're trying to figure out how the heck do you get out of this hole. And so in today's video, I'm going to be breaking down some of the different steps that you can take in order to protect yourself, recoup some funds, and sell a vehicle that you may be underwater on. And this could potentially save your finances if you found yourself in this situation. So let's get started. Now, I've been talking about underwater loans a lot on this channel. A few weeks ago, I broke down in a video how Turo hosts are becoming underwater on their loans. Last week, I broke down a new TransUnion report, which basically stated that more and more people are becoming underwater on their loans, and thus delinquency rates are expected to rise. And I think that as the car market is falling, this issue is becoming more and more important because more people are finding out that they are in fact underwater on their own car loans. And while there are a ton of videos here on YouTube breaking down underwater car loans and what you should do in these situations, I feel like more often than not, these videos are addressed by financial experts, not really people that actually work in the automotive industry. And so I thought that this would be a great time to make this video and to give some insight into what you can do whenever you're in this situation from the perspective of somebody that not only enjoys and has passion with personal finance, but also knows a lot about the car market and what you can and should do if you need to sell a car. But before we dive into what you should do if you're somebody that is currently underwater on your car loan, let's first address some of the biggest things that you should do in order to avoid getting underwater in the first place. Number one is to buy new. This is one of the best ways to avoid getting underwater on your car because if you are somebody that is buying a new car, chances are the moment you drive off of that car lot, you are going to become underwater on that vehicle immediately. And while of course you do have things like gap insurance that will protect you in the case of that car getting wrecked, you ultimately have no way of protecting yourself in the case of you hitting a financial snag where you need to sell your car in a case of emergency. There is no way to financially protect yourself if you need to sell that car, only if you wreck that car. Because of that, I think that buying new is in general a really bad decision for car buyers unless you're somebody that is really financially secure. The number one argument that I hear from people who want to buy a new car is that they want a car that's reliable. They don't want to buy a used car and run into issues later on down the road. They just want something that's new, that's safe, and that isn't going to cause them any issues. And while I understand that this argument is well-intentioned, it is incredibly flawed. Because the reality is, a car that's a 2018 isn't going to be significantly less reliable than a car that's a 2023 model. And depending on the type of car that you buy, some 2018 models can actually be more reliable than a newer one. I just think in the majority of cases, it's a really bad idea to buy new, especially if you're somebody that doesn't plan on keeping that car forever. I am such a proponent of buying used. You can find really great, affordable, reliable cars that are used, and you can save yourself a ton of money in the process. And by buying a car used, you're able to protect yourself from that increased rate of depreciation. And if something was to happen and you needed to sell that car, you'll have a much easier time doing that and recouping the cost of that vehicle. So if you're able to, I highly, highly encourage you to buy used and avoid buying new at all costs. Next is pay attention to interest rates and don't buy a car that has an absolutely insane, astronomical rate. It simply isn't worth it. Interest rates in general don't have as much of an effect on a car purchase as they do, say, a home purchase. And because of that, I feel as though interest rates aren't as emphasized in the car market as they do in the home market. And to a degree, this is valid. I mean, higher interest rates can cause a home mortgage payment to increase by thousands of dollars, whereas this isn't really the case with used or new cars. But that doesn't mean that you shouldn't pay attention to interest rates, because as we see here today, interest rates are on average about 11% for used cars. And there are tons of borrowers out there that are getting approved for rates between 11 and 20%, sometimes even higher. And these types of interest rates are the types of rates that will cause a borrower to be underwater on their used car forever. If you are somebody who buys even a modest, affordable used car for say $10,000 to $15,000, but you can only get approved for an 18 to 22% interest rate, you are going to be in a hole of getting out of that car debt for years. You're going to pay a ton of money in interest, you're going to be underwater in that loan forever, and it's going to take you an extremely long time to pay off that loan, and once you do, you probably could have bought that car 2 times over with the amount that you spent on interest alone. Because of that, if you are somebody who's wanting to finance a vehicle, I would be very cautious about the interest that you're paying. If you can't get approved through a traditional bank, I would look into a credit union because in the current market, they tend to have the best rate. In fact, the credit union that I'm with is currently advertising about a 5.5% interest rate on used cars, which is an excellent rate in this market. And third, make a down payment on the vehicle. Even if you're approved for your car loan without a down payment, I highly encourage you to make one, and if you can make one of about 20% or more, that would be best. It's very easy to justify not making a down payment on your vehicle purchase because whenever you break down how much a down payment brings down your monthly payments, it really isn't a lot. The general rule of thumb is that every $1,000 that you put towards your vehicle purchase is only going to bring down your monthly payment by about $20. So a lot of times people justify not making a down payment or making a smaller down payment because there are better things that they can do with that money. And sure, if you're somebody that's flush with cash and you really are trying to optimize every single one of your investments, maybe in some cases it doesn't make sense to put a down payment if you get approved without one. But I would say for the average American, that money doesn't then get invested into a higher return investment. Instead, it just gets spent. Because of this, I highly encourage you to put a down payment on your car, whatever you can afford. If you can afford 20% or more, that is the ideal situation. But even if you can't afford quite that much, I encourage you to put a down payment. Loans that have a high loan-to-value ratio at the point of origination or the point of purchase, these are loans that are much more likely to go delinquent later on. So protect yourself from this by putting down a down payment. You will thank yourself later on. And of course, this sort of goes without saying, but don't overpay for a car either. This is an excellent way to become underwater. But then this, of course, begs the question of what can you do if you're somebody who's underwater on your vehicle loan today, and what are some of the things that you should avoid doing? One of the more common approaches that you can take whenever you have a vehicle loan that you're underwater on is rolling that negative equity into a new car loan. So let's use this scenario where you have a Toyota and you go and trade that Toyota in so that you can buy a new car. After you get your trade-in value, you still owe $5,000 on that car. Well, you're wanting to buy another Toyota for $30,000. So the way that you can do this without having to come out of pocket for that $5,000 that you owe on your first Toyota is for the second Toyota, you would simply take out a $35,000 loan for that $30,000 car. In turn, you're able to pay off the $5,000 that you owe on the first car, and you're able to buy this second car. But now you have this car that's worth $30,000, but you owe $35,000 on that car right out of the gate. This is a bad idea, and unless you get an incredibly good rate, which isn't going to happen in this market, I would encourage you to avoid this at all costs. This is a situation where you are becoming underwater on your new car immediately. It's going to be very difficult to catch up on those payments, and then later on down the road, if you want to buy a different car, you are now even more underwater on the car that you just purchased. And again, like I mentioned a moment ago, vehicles that have a high loan-to-value ratio right at the point of origination, these are cars that are significantly more likely to go delinquent. So if you are somebody that's rolling negative equity into your car loan, you have a much higher chance of delinquency later on, which isn't good. I think rolling negative equity into your car loan is another version of kicking the can down the road, so here's what I would do instead. So first is if you are somebody who doesn't need to get that newer car, simply don't get it. There are a lot of people who roll negative equity into a new car loan simply because they wanted a different car. But the reality is wanting a different car isn't a good enough reason to dig yourself into a bigger hole of debt. The only scenario where I would ever think of buying a different car while I'm underwater on my current one is if there was a set of circumstances that I simply couldn't avoid and I had to get a different vehicle. And let's face it, those types of instances are few and far between. So if you are somebody that does have negative equity, I would encourage you to just keep your car until you've paid it off, or at least until you're not underwater on that vehicle any longer. Another option is to privately sell your car. Going to a dealership is one of the worst ways to get the most amount of value from a trade-in. And so instead, what I would encourage you to do is sell your car private party. Depending on how much negative equity you have, you may not be able to make up the difference, but you will be able to make more from a private sale than you will be by trading in your vehicle at the dealership. So if you are somebody that's in this situation, do your research, figure out how much the car is worth, clean the car, make it look nice, take great photos of it, and then list it on Facebook, Cars.com, or Craigslist. And if you do that, I almost guarantee you that you will make significantly more from that private sale than you would have made if you did an easy, simple trade-in. Sure, it takes longer, it is more work, but it is worth it. This can, in some cases, make up that negative equity altogether, but if you're not able to make that negative equity up, it'll at least decrease the amount that you owe. And then once you've done this, if you've purchased that car, you've sold it private party, but you still owe money on your old vehicle, or you're still going to owe money, then in that case, rather than rolling the negative equity into your new car purchase, I would simply take out a personal loan in order to cover that negative equity. I would buy that car, and then I would pay off that personal loan as fast as possible. If you need to get a second job or a side gig in order to do that, then you need to do that. I hate personal loans. I think that this is a worst case scenario, but if you are someone who finds yourself in this situation, this is the route that I would go. Now, this scenario covers you in the situation that you have a car that you have negative equity in, and you need to buy a different car and find a way to cover the difference. But there are a few different things that you can do in order to get out of a car loan that currently has negative equity, or at least help you get out of it. You could refinance. Sometimes refinancing a car loan could help you get out of a negative equity situation if you're someone that had an atrocious interest rate in the first place. For example, if you got a car loan for say 18-20% and now your credit is significantly better, then refinancing could be a great bet. Keep in mind that given the current car market, refinancing isn't a super realistic thing to do, but in a year, whenever interest rates are lower, this could be a good option. And while refinancing may not make a huge difference initially, it will over time as you're able to make payments on that car with a lower interest rate, and thus you have more of your car payment going to principal. Another option is to make additional payments. It always blows my mind how making additional principal-only payments can speed up a loan so significantly. Even doing $100 to $200 extra a month can really chip away at your loan quickly. And if you are somebody who has found yourself with negative equity, and if you're somebody that has a bad interest rate, making additional principal-only payments could be a game changer. And the last scenario that we have to talk about is a situation where you just simply cannot afford the car that you have any longer. Maybe you lost your job, something came up, there was an emergency. Regardless, you can't afford the car anymore and you have to do something. Well, one option could be you could rent it out on Turo. Now, this isn't an ideal situation, but it is an option. Or alternatively, you could in some cases just let the car get repoed. If you find yourself in a scenario where you are simply too underwater on that car, your financial situation has degraded significantly and you are falling behind on all of your other bills, in some cases it may just be worth it to let that car get repossessed. Now obviously this is a worst case scenario and it's going to have a large impact on your future finances and your future credit score for a very long time, but it isn't the end of the world. And if you are somebody that has found yourself getting behind on bills, getting your car repossessed is a much better option than getting evicted. There is, of course, a major stigma associated with this, but in some cases, it could be a good option. Now, truthfully, if you are somebody that has found yourself with negative equity, keeping the car and making extra payments is going to be your best bet. But if you need to get another car or if you have to change your situation, these tips that I've outlined in this video could be great paths to pursue as well. Like always, you guys, I hope that you enjoyed this video. If you have any questions, comments, if you have anything to add, I would love to hear it, so make sure to leave a comment down below. And while you guys are at it, make sure to hit the like button, hit that subscribe button, and hit the notification bell, and I will see you guys in the next video.